Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio. The purpose of this presentation is to look at the investment outlook as of mid-June and see if there are signs of expansion and what we experienced since mid-March on the stock market. Is this the beginning of a new bull market? In order to answer the question, we need to look at what happens to the business cycle. Since 2018, as you saw from previous videos I have, the economy has been slowing down and went slowly down like this. And in that this time here, we had the virus scare. And now the issue is, are we now beginning to pick up growth? So what happens here should be totally different from what happens in this phase of the business cycle. Why? Because this is where the economy really slows down and this is economy strengthen. I am a firm believer that the inventory cycle has a tremendous importance of what happens to the overall economy. Well, call me old-fashioned. But if you look at the growth in inventory, the business cycle started slowing down in 2018 when sales slowed down and inventories were building up. At some point, business recognized that inventories were way out of line compared to slower growth in sales, so they cut production and you had to slow down. Now you have inventories contracting quite sharply, as you can see here, more than what happened, for instance, during the mini cycle of 2016. So what is going to happen is pretty soon business will say, wait a minute, our inventories are so low that need to be replenished because there is always demand for minimum demand for their goods. So this negative in inventories is a positive, like here, too much inventory was a negative. Let's see now what the markets are telling us. Since 2018, when the economy slowed down, stocks of metals and mining companies weakened. Why? Because raw material prices decline, and of course, sales and earnings decline as well. But look what happens here now. Raw materials are now in favor again, and the sector is quite strong. It started in March. So this would indicate, as the first sign, by the way, that it would indicate that the economy is improving, like it happened in 2016 when the economy bottomed, the mini cycle of 2016 bottomed and they started rising. So this is a good sign. This chart shows the retail stocks relative to the S&P 500. So declining means that retail stocks are weaker than the market, but when they rise, it means that retail stocks are rising faster than the market. This is what you usually see at the bottom of a bear market and indicating that the economy is improving. This chart shows credit spreads, which is the spreads between the treasury yields, the safest, and junk bonds or high yield bonds. And what you see that at the bottom of a bear market, you see credit, of course, spreads are very high, indicating risk because they went through probably a recession and high credit risk. But then as the economy expands, there is more safety built into the spreads and the spreads decline, and this happened here, and again it's happened here too. In other words, at the end of mid-March, where risk was very high because of the sharp contraction in the economy, but now spreads are declining, meaning that there is less credit risk, which is what you see at the bottom of a bear market. Another important indicator to follow to see if we are at the bottom of a bear market or not is the ratio between high momentum stocks and low volatility stocks. These are stocks based on growth, and these are defensive stocks. When the ratio increases, means that growth stocks are doing much better than defensive stocks. In other words, investors know that the economy, are confident that the economy is going to is going to grow, expand, and so they bid up prices of growth stocks. When the economy instead slows down, then of course investors move the other way. They sell the high momentum stocks, and low volatility stocks during the slowdown period are stronger. But look what happened now here since mid-March. Growth stocks have performed much, much better than the defensive stocks. And this is exactly what you usually see at the bottom of a bear market. The answer to our original question is, what are the markets telling us? Well, we have seen that commodities have been strengthening. So this is what happens in phase one of the business cycle. We saw that retail stocks are stronger than the market. That is, they're appreciating faster than the market, which is what you see during this period. I didn't show you transportation stocks. They're also stronger than the market. We have seen high growth stocks performing much better than defensive stocks, which is also what you see in this phase. During this phase, instead, you see defensive stocks stronger than the growth stocks. You also see that spreads are declining, meaning that financial conditions are improving, and when financial conditions improve, that's when the new bull market is underway. So really what the markets are saying, the contraction, the slowdown that started in 2018 is over. The economy seems to be mending, and a new bull market is underway. Of course, we will follow these indicators and we'll update you with the video. I would like to remind you that we publish the Peter Dack portfolio every Sunday, and is available on www.peterdack.com. And really, in every issue, we cover all this kind of subjects that we have dealt with this presentation. I wrote a book, Profiting in Bull Bear Market, was commissioned by McGraw-Hill. Education is available in Asia in several editions. It goes in detail, no formulas, no charts, no many things, but try to explain what is the relationship between business cycles and various markets, how business cycles drive and are driven by commodities, business decisions, financial markets, the Fed, and everything. And it's a pretty comprehensive study of explanation, more than study, of how business cycles work. This is an analysis of a study that I made on how certain portfolio using ETFs behave. What is their volatility? What is their maximum losses, minimum losses? What are the features that portfolios should have to have good returns and low risk? This is another book which is the follow-up of this, and it finishes with ends with in chapter 9, which shows and discusses in detail a way of investing and selecting stocks that quite frankly, I'm very proud of it. Hopefully you will see why.